Hello and welcome. My name is Benoit Poliquin. I'm the founder and one of the portfolio managers here at Exponent Investment Management, and you're watching the first quarter 2021 quarterly review. This is a longer edition, and so we're going to be showing you the charts and the work that went into some of the conclusions that we have for the quarterly review. Thank you for watching. The first quarter was a continuation of a shift that began midway through the fourth quarter of 2020. Let's call it late October, early November. The reopening of some of the economies globally, such as the US, as well as some Asian economies, thanks to infection control and vaccination efforts, accelerated this economic rebound. But as we look forward, there's still some questions around COVID-19 and its impact on the rest of the world. From a lockdown perspective, and death rates, and all of these sort of negative impact from this terrible public health pandemic. What's interesting to note, however, is that as these lockdowns continue, so case in point would be France, they're just announced last week, as of the time of this recording, a third set of restrictive lockdowns. However, the CAC 40, which is their large stock index, is flirting with all-time highs. So this is the third set of lockdowns. Economically, the economic agents like consumers, businesses, as well as investors are kind of getting used to it. They're looking past these restrictions. A year ago, during the first lockdown, markets imploded. So what a difference a year makes. However, there's still some issues with lockdowns. The first one is the integrated supply chain. So you think that the global world economy as Asia being the factory, the US and Canada being providers of inputs, if you will, or tools, and all of the things that you need to make end products. And you can think of Europe as the provider of tools and software and higher end components that go into the outputs from Asia. So when we had this interruption beginning in the first quarter of 2020 in Asia, and that these lockdowns moved east, you kind of created these air pockets. And these air pockets, we're still working our way through them. So whether you're talking about, we're going to talk about chips, also we can talk about interruptions in factories and access to certain products. Think of wood as an example, or steel, or chips. There's still a problem with that. So looking forward, we're really thinking about what impact will this have on the potential for a full recovery. If we move our attention to the economic system, let's view it as a pressurized system, just like pipes. And it needs a constant flow of money to operate. If you have too much pressure, you can have inflation, and it's not good for the system. If you don't have enough pressure, you have prices deflating. Effectively, you have this terrible circle of prices coming down and economic agents waiting for lower prices, and so economic activity actually becomes slows down and actually can become permanent as well. So that's why governments, central banks initially, really injected a lot of capital into the economic system, lessons learned from previous crises. The unintended consequence, actually I would say some of it was intended, was to continue to have some sort of asset inflation. So we've had housing go up in value globally. We've had obviously stocks, which benefited stock owners, business owners, all sorts of assets went up in value. What's interesting, though, is consumer price inflation, or the consumer price index that tracks the consumer price inflation, really hasn't reflected that yet. The official numbers are still 1.5 to 2.5%. So looking forward, we're going to be watching those numbers, because when we look at the commodity prices, whether it's copper, lumber, oil, all sorts of commodities, they've gone up in value substantially. Looking forward, government spending, We're going to show you some charts on say, we all know the headlines that Canada's, from a debt to GDP perspective, which is one of the measures we measure government indebtedness, is higher than it's been since the early 90s. Well, we'll show you that actually Canada is now mid-pack, where it wasn't back in the early 90s. So while governments are our Canadian government is in debt, so are most other governments as well. Looking forward, healthcare spending has gone up. A lot of research and development has gone up. So it remains to be seen whether this is the beginning of a boom time or it's just a blip. Direct and program spending on behalf of governments. So both from a healthcare perspective and from a programs perspective, these are a way for governments to get involved. The spending gets into the economy. It remains to be seen whether that continues, because really the question mark is really around debt levels. Can governments continue to borrow at the pace they have been to continue to inject the money in the economies? And finally, investors will be looking for stability and predictability, both in interest rates, taxes, and politics. Whenever there's uncertainty, and we had an example of that last March, whenever there is uncertainty, investors sell. So if we look at the performance summary that we show you every quarter, there's some interesting notes. Number one, our home index, the S&P Composite, the TSX, let's call it the TSX for short, turned in a whopping 8.1%. Quite a reversal of fortune from the tech-heavy index, which turned in still a pretty good performance of 1.4%. And then somewhere in the middle is the S&P 500, which is tech-heavy, but not predominantly tech like the NASDAQ. Another interesting point is that the Canadian bond index turned in a negative 5% return. This is new for many investors who had never seen rising interest rates, which drove the negative performance, and where you actually can lose money owning bonds. A brand new experience for many investors. The other thing that's important of note is the slope of the yield curve. So why that matters, we've talked about the slope of the yield curve in the past. We talked about flat yield curves, inverted yield curve. Now we're going to talk about a steep yield curve. And that's great for banks. Why? Because banks will borrow money in the short term, so buy deposits effectively, and then they'll lend out money in the longer term. And one of the indicators of this slope is the 2-year bonds compared to the 10-year bonds in terms of their yields. At the end of December, the difference was 0.3%, which is flattish. In the US, it was 0.55%, which is a little bit better, but not much. And over the course of the year, or the quarter, we added effectively 100 basis points to the steepness of the curve. And that's great for banks, it's great for loans. So we're seeing that it really drove the performance of Canadian banks, ergo it drove the performance of the S&P TSX Composite Index. You'll also notice that the 10-year bonds in Canada and the US have gone up substantially, which explains the negative performance of the bond index. We've gone from 0.88% for a 10-year term up to 1.55 or 1.57% at the end of March 2021. So really a large move up in interest rates turns in a significant move down in bond prices and performance. One of the items we've been tracking in terms of performance anomalies is the difference between the focused list of stocks that make up some of the indices. So in the US, we've been harping on this for most of 2020, where 10 to a dozen names really were driving the performance of the S&P 500. Well, that situation's been reversed. So we have a much broader index performance this quarter for the US index. So you can see that the top very focused names only turned in 1.1%, whereas the broader index turned in 5.7% for the quarter. And that's good, that's healthy. If we look at the names that drove the performance, we have some of the usual suspects, technology names, but now we have banks, we have semiconductors, oil companies, another tech name, let's call Berkshire Hathaway a conglomerate, and Home Depot a retailer. And so it's a broad collection of names. That's really healthy. The TSX, however, completely different story. Very focused names. If we go over the names here, we're basically all effectively Canadian financials, Canadian banks specifically, insurance companies, and a couple of pipelines. So the TSX turned in a very focused performance this quarter. With keeping our mantra of having an open mind about better than expected and worse than expected outcomes, we really are expecting a bit of both. We really don't know the sequence, but here are some of the variables that we're watching. Let's start on the pessimistic side. Lockdowns, they're still happening both globally and in certain regions. New variants always bring up whether those vaccines that we've come up with, whether they can fight off the variants and whether these variants are more virulent and easier to spread and ultimately more deadly. So if you're pessimistic, that's some of the things that we're looking at. The wealth gap continues to widen. And why that's important is you can't really have a healthy and sustained economic recovery without bringing or including most of the people or most of the economic agents in the economy. Political turmoil, public fatigue around health measures and the stress on the health system, that obviously is still going on. On the optimistic side, well, if I told you a year ago that we'd have 3 sets of vaccines and nearly 5% of the world population inoculated against COVID, that would be considered a good thing. So the jabs are a reality, and the vaccine rollout is certainly a reality. Not perfect, but it is happening. The number of jurisdictions that are reopening, they're new jurisdictions that are opening every week, and that's a great thing. Liquidity in the system, unlike the 2008, 2009 Great Recession, where there was no liquidity in the system for a long period of time, it's not the issue this time around. So yes, it drove up asset prices, but the economic system itself is in good health. I should say the banking system itself is in good health. The government stimulus programs, they're still going on, and so that's really bringing in or trying to keep as many economic agents, if you will, whether it's small business, consumers, people that are out of work, still active in the economy. And that is an optimistic thing because a lot of these economic agents, once they fall off or remain or become dormant, it's really difficult to get these economic agents active again. A lot of companies have gotten much better as operators, whether it's adopting new technologies, adopting to the lockdowns. You can think of curbside pickups, you can think of Zoom meetings, you can think of all sorts of technology adoptions that would have taken years, even decades to take in, were really adopted in a matter of months. And those improvements in operations will remain. One can think of, my favorite one is, and I'm sure for many of you, is the electronic signatures. Well, it took years to put that into place, and the adoption rate has been phenomenal. The path back to normal, again, if we look back a year ago, it was cloudy. Now we have a pretty clear path back to normal. And there are a lot of new jobs that will be created out of this pandemic, and that's a good thing. Right now we're staring at the job losses, but there will be some good come out of this as the pandemic created or highlighted some of the issues, some of the problems that we all had, and some of the new jobs that can be created by solving these problems. We're going to quickly go through the winners and losers in terms of sectors for the quarter. We continue to update this list every quarter as it's part of a prevailing winds type of approach to portfolio constructions. As the pandemic unfolds, the list of winners and losers does change, and we adapt to these changes. It doesn't mean we only buy the companies at the top and avoid the companies at the bottom of this list. It's really about what's baked into the price. Are the expectations too high or too low, or the price is too high or too low? As an example, many portfolios we added oil throughout 2020. which was a controversial call as oil was coming down, and a lot of these positions initially were not making any money. However, those positions largely drove some of the great performance of the first quarter of 2021. So the thing about investing is that you have to be willing to buy when everyone else is selling and willing to sell or trim when investors are in love with the sectors. So this type of activity, it opens you up as a portfolio manager to being early and opens you up to criticism. Unfortunately, that's the price of admission. So if we look at the list, resources, oil, lumber, metals, obviously we didn't catch all of these sectors, but these sectors did very well in the first quarter. Manufacturing, as it's ramped up, has done very well, as has logistics and transport companies, because you get more goods to produce. There's simply more traffic, and we'll show you some charts around the maritime traffic, which is just completely outstanding, mind-blowing, I should say. Direct-to-consumer, that's not a new set of winners and losers. Companies that are able to sell their wares, their services directly to consumers have been a big winner. Local travel in the U.S., that's done very well, and we'll show you some charts for that. But stay at home, the business in Canada, the U.S., and in Europe has done well as these economies remain locked down. On the bottom end, well, solving problems for the digital age. So think Peloton, think of a lot of companies that profited from cocooning, or for companies to get on and get better, become more and more digital. Well, those efforts continue, but whether there's new entrants to this effort remains to be seen, or certainly will the pace continue, should be the better question. Stay at home in the U.S., well, that's not doing as well for some of the states that are reopened. Clearly, if you've been boxed up in your house for 6 or 9 months, going to the restaurant or going out completely is your main priority. It's reflected in travel traffic, in foot traffic, and in terms of the spending dollars. Foot traffic in bricks and mortars in the U.S., in Canada, and the lockdown parts of the U.S. and Europe. Obviously, that's not performing as well as you'd like. Travel and entertainment, and specifically business travel and conventions globally, are still dormant. And finally, the crowded and confined experiences like live entertainment, cruises, that's still really dead in the water. The prices of the stocks have come back, but really on the anticipation of traffic. So the real question for these stocks is, how much of the anticipation or good news is baked in, and is there too much expectation in the current prices? Downtown versus suburbs, from a real estate perspective, that's really the question. For many years, we had supply of new housing largely be driven by infill projects and sort of bringing people into downtown. If we look at the Vancouver or Toronto or Montreal skylines, we all have noticed the new towers have gone up. However, during this pandemic, and that's true in the US as well, and even in Europe, you sort of had an exodus of people leaving the downtown core for either secondary cities or the suburbs or the far suburbs. So looking forward, whether that remains to be or continues to be a trend remains to be seen. What hasn't changed is our commitment to these 6 principles of stocks we want to have exposure to. So a dividend focus, and if it's not a dividend stock, it's a company and its management that is friendly to shareholders, either by special dividends or buybacks or simply not diluting the share float. So we're really looking, so dividend focus, yes, but also we are willing to expand this definition of dividends to, let's call it, shareholder friendliness. Quality balance sheet, that remains we remain steadfast on that. Proven management, global approach. So whether it's a global company or a Canadian company that has a global footprint, valuations remain important, and really ignoring headlines. We've done so all the way through this pandemic, and will continue to do. That really has not changed and will not change. Some of the adjustments, well, rising interest rates. We've had to adjust to that and inflation expectations, whether that remains to be something that is normal. This inflation story is normal coming out of a recession, whether it stays with us or not. The current narrative from central banks is that it will be momentary. Direct to consumer, brands, location, and moats, those are things that we're looking for in companies all of the time. And this K recovery, this wealth gap, we're watching that, and we're trying to get exposure to the companies that are benefiting from this K recovery. And government policies, really, this pandemic has shown us that policies from governments will have the unintended consequence of creating winners and losers. If we look at some of the headline roundup for the quarter, really the story has been around vaccines and the rollouts, inflation, and a global supply chain problem and shipping problems. Those have really been, for us anyway, the important headlines that really have driven both either performance or made us think about what to do for the coming year. So as promised, we are going to enter the really funnest part, for me anyway, of the presentation, which are the charts. First chart of the day, government stimulus. So what we're looking at are the bars, and these bars are the government deficit, and this is either expressed as a percent of GDP, and these different colors are the timeline of the updates, if you will, or expectations or estimates. So we see here that we had sort of in Canada very small budgetary deficits, and coming out of this pandemic absolutely exploded. So 400 billion is the expected deficit for 2020-2021, and another 150 billion for the following year. As a percentage of debt to GDP, I alluded this earlier in the presentation. So this is the yellow line is Canada, and we see that the early 90s was well over 100. Let's call it 110% of GDP, and the Canadian government really brought that down substantially, down 40%. And here we are again, and we're now at 116% of GDP, which is higher than it's ever been. Back in the 90s, Canada was one of the worst jurisdictions. And the only worst, the dirty shirt was Italy. And now we're kind of mid-pack in terms, we're not the dirtiest shirt, but we're not the cleanest one either. We're kind of in the mid-pack. So Canada's gone from early 2000 to one of the best balance sheets, as expressed as a percentage of GDP, to sort of mid-pack. And if this is kind of a riddle that we're trying to sort out. So we're looking at inflation numbers from central banks. They're all at the 1.5% to 2.5% numbers. But then we look at some of the commodities, and we just can't square it up. You have steel going up 35%. And there's even talk and evidence of steel shortages for certain operators. You have oil going up 22%. You have cotton, corn, lumber. I've seen lumber shortages at our local lumber yard. Copper's up 14%. Pretty much everything is up except for gold. And so it's interesting to see how seems to be a disconnect between published consumer price indices and the inputs that go into making all of the things that we consume. So obviously, the main one is the chip shortage. So computer chips are in short supply. There's been headlines of GM having to shut down plants because of a lack of supply. Same thing for Mercedes-Benz and some of the European producers as well. And here we have the SOX ETF, which is basically all of the large chip manufacturers, their stock price. So you can see that it's very economically sensitive. So we've had this massive downfall in the first quarter of 2020, and we've had downfalls before of a magnitude of 33%. So it's a very volatile sector. But it's basically, since the lows of the last quarter, the sector is up nearly threefold. And so it's largely a couple of things. One is you have normally in a volatile commodity type business, which the chips are, manufacturers are looking for a balance between supply and demand. And so when demand falls off because of an unintended or unforeseen event like a pandemic, it takes a while for suppliers to cut supply. And when they do, they're trying to protect their margins. And what happened is the demand came back quite quickly. And so what suppliers did of chips is they moved the excess supply and they moved it off to other sectors. Because of the stay-at-home factor, a lot of people started buying computers and the demands for servers and cloud computing went up. That's why the index rebounded so quickly. But here we are, as the rest of the economy starts to fire up, the demand for chipsets also continues, and yet the suppliers really took time. It will take some time to adjust. So if we look at a car, there's a lot of chips, a lot of computing power in modern cars these days. A lot of demand for chips. But this chip shortage is not new. We had it at the end of the last recession in 2011, and here we are again 10 years later. So it is normal, and what cures high prices or a lack of supply in a high demand area is simply time, because suppliers want to meet this demand and want to capture as much of the higher prices as they can. Another interesting chart and is the difference or the path between performance, or how one gets to performance. An interesting point that I want to highlight here with this chart is the difference between stay-at-home stocks and the S&P 500 versus the pandemic stocks, let's call them the economically sensitive stocks, versus the S&P 500. So my point here is technology companies did very well, the stay-at-home stocks did very well early in the pandemic, the first 6 months, and more or less flatlined. So think Amazon, or think whatever stay-at-home stock that you want to think about. And then the economically sensitive stocks actually fell out of bed, as opposed to, or as compared to the S&P 500. So they did way worse. And then starting around October, November, really churned around their performance. So the performance of these two subsectors is quite similar. They just took a vastly different path. With this chart, we're trying to answer a question. Are interest rates bottoming? So what we have here is the 30-year Treasury Yield for the US. And we look back to 1991. And you can see a price channel. It's fairly defined. And the yields are, one way down, but they're moving around with this channel quite substantially. What we noticed at the end of last quarter is it exceeded this price channel. And it's done that before a couple of times. 1, 2, and touched a few more times. So is this a head fake, or is this the turn that I've been running money professionally since the early 2000s. I think 2000 was my first year. And so effectively many money managers have been running money in a down market from interest rates. And the same could be said for investors. But I've been running money since 2000, and I can tell you that every year is the year that interest rates are going up. So again, I don't know if this is Charlie Brown's football and another head fake, or is this simply another touch on the higher end of the channel, only to move down again. Time will tell. So we talked about inflation so quickly here. The China Producer Price Index, or PPI for China, we're seeing obviously it came down in 2020 as their economy locked down, and then we're seeing a spike. The point here is, as we're looking at CPI and it's not moving, the Consumer Price Index is not moving up, or still within the band that the central banks are telling us they want to be in, we're looking at what goes in the Consumer Price Index, is what the producers are doing, and they're seeing a price increase both in China and in the US. Very similar chart. So the absolute number is obviously smaller, but it remains to be seen. Now, if you take anything away from this presentation, it is this chart. This is the M2, and it's a percentage of the money supply. So let's call that a measure of the growth of money in the economic system. If you remember, the economic system, the analogy I use is a pressurized system. So there's always a bit of growth of the money supply because you need that for the pressure. But since the beginning of 2020, 21% of all outstanding US dollars have been printed or created in 2020. It's mind-blowing. I'm going to repeat it. 21% of all US dollars in circulation or printed have been created in 2020. So a couple questions I have is, well, how are they going to be taken out of circulation, if at all? And secondly, you saw price inflation of many asset classes and commodities around 20%. So it only squares up that if there's more money by the order of 20%, that asset prices go up by 20%. So maybe the inflation won't happen at the consumer level, it actually happens at the asset level. So the unemployment rate, well, that's just Canada's unemployment rate. So we had a really sort of massive run up, and now things are getting better. But the real question is, will we go back to this sort of very low inflation level or low unemployment level? Because every time you get a recession, you have economic players or labor falling out and never to come back. People retire, they simply don't get involved economically. The other problem that we've had pre-pandemic is the skill set difference between skilled labor, let's call it welders or plumbers or all sorts of skilled labor that's required, and the later supply that doesn't fit the demand for this skilled labor. So we have this demand and mismatch. So we kind of, there's an over demand for certain skill sets, and there's an oversupply of people that have training that no one, we call them the history degrees, the people that don't really need. It's great to have a history degree and have a lot of time for the liberal arts in terms of some of the skill sets you develop, but they're simply economically not in need. And so the challenge is, and a lot of these graduates have found a home in the service sector. And as the service sector has effectively been shut down, and the question is, when will it open up and how will it open up and at what speed and what breadth, we still have this blue-collar skill set in demand. And so that's really skewing some of the numbers. Bitcoin, well, I'm just going to put this chart out because we got to talk about it. You want to talk about speculative examples, Bitcoin would be one. Maybe it's the dawn of a new era. Probably is. However, this type of growth, when it goes parabolic, is the definition of speculation. Here's another example of speculation, GameStop. You may have heard about it. It's a company that was mall-based. In Canada, it's called EB Games. So they would have these small mall stores or kiosks, and they would sell video games. As a father of a 14-year-old, I can tell you that my 14-year-old doesn't want to go to the mall unless he has to go with his mother. Well, this time it's currently closed. So buying video games now happens over the web. So why are investors adding and making now it's worth about $6 billion in terms of market capitalization in a business that's effectively being rendered obsolete to the new distribution model of video games? So that, again, is a great example of a lot of money chasing ideas. Another example, SPACs, special purpose acquisition companies, also known as blank check companies. So investors effectively buy a shell. They have no idea what this shell will buy in terms of operating company, but they put the money up first. The SPAC index has gone up effectively nearly 80%. It's down from the beginning of the year, but still substantially up from the levels of last summer. So that's a great example to me anyway of speculation. Household saving, another interesting chart. So we had high savings rate in the early 80s when interest rates were sky high. So you were actually being compensated for savings. And you had come out of an area where inflation was high, the 70s. And so as this inflation kind of spiked, people began saving more, and actually there was a compensation for it. As interest rates came down and economic stability and prosperity came back, the propensity to save came down right along with it. And it's entirely normal. But here we have this massive spike in savings thanks to government support. So the government of Canada sent out an unbelievable amount of money, and it was quite broad. And so a lot of this money either wasn't needed or the situation of the economic agent is still uncertain, so that those economic agents are banking the money until they get more clarity around the end of the pandemic. Again, I like to show some of the movers. So we have here the tech stocks. Keep an eye on them. They really had a rough February and March. As of the time of this writing, late March and April, a lot of this performance has come back. But the thing about volatile stocks, we look at Tesla at minus 26%. So a lot of these names have gone up tremendously, but they also rip down just as easily. And everyone loves volatility except on the downside. Here we have some commodities. So the oil price, that's kind of a blip. So let's call it really sub $20 as a low. We're back to pre-pandemic levels. Copper is also higher, substantially higher from pre-COVID levels, which is interesting because copper is really economic agent or an economic indicator. So we have a global economy that is back, but let's just say it's moving at 80 or 90%, yet copper is basically 30% above its pre-COVID levels, which is interesting. Lumber, well, anyone that's buying any sort of woods for home renovations or really anything of that nature, the price of lumber from pre-COVID levels has effectively gone up over 100%. So is this a supply and demand imbalance? It remains to be seen, or whether suppliers will rush to capture these higher prices and offer more supply. It'll be interesting to note how that plays out. The Treasury yields, well, I talked about it in the performance, but here's visually what the interest rates look like. We're not to pre-pandemic levels, but we're getting there. So whether the interest rate, this is the US 10-year, whether we go back to these levels, so let's call it just under 2, or whether we go back to the 2 to 2.5 level remains to be seen. But it's important to note that as interest rates rise, technology companies also fade. Investors view them as long duration assets. So basically it's a complicated way of saying that the profits are so far off into the future that they're very sensitive to change in interest rates. Same type of chart here in Canada. We're probably a little bit further along in terms of capturing pre-COVID levels. It remains to be seen whether interest rates stay here or whether they move forward. Here we have sort of the value index on the left. So we had in investing, there's really two teams: growth investors and value investors, and those stocks tend to be. We try to personally at Exponent, me personally as a portfolio manager, but also all the portfolio managers at Exponent try to have a mix of both value and growth. But it's interesting to note that the value names have again done tremendously in the first quarter. When they're up, the value index is up 21%. And then as illustrated below, the rally has been broad-based in the S&P 500 as opposed to the equal weight, which is a better measure, if you will, of the broadness of the index. So the RSP, when it's up above the S&P, that tells us that the rally is broad, and that's a good thing. Here's our chart for the S&P 500. The important note here is that basically it took the S&P 500 crossed 4,000 at the end of the quarter for the first time. It took 5 years to go from 2,000 to 3,000, and basically 21 months to go from 3,000 to 4,000. So again, is that thanks to 20% more in liquidity? We would argue that a lot of the record territory that we're in is thanks to central bank interventions and this added liquidity, rising all asset prices. Same story here in the TSX, where we've had, just record highs. We're above pre-COVID levels, largely thanks to government intervention. This chart is also a very interesting one. This is a global shipping chart thanks to Bloomberg. So here we have basically the boats on the water. We can see in March of 2020, most boats are not on the water. They're in ports somewhere in the world. Fast forward a year, and these are all the boats on the water globally. So even though we have an economic lockdown in Europe and South America and parts of Canada, or all of Canada, I should say, there's still a tremendous amount of shipping traffic. Again, we talked about earlier about local travel in the U.S. So here's a TSA checkpoint. So these are the fine people that bring you the security checkpoints in U.S. airports. So they track travel. So we're back to basically 75% of foot traffic in the U.S. in terms of normalcy, if you will, in terms of travel. We're not back to pre-COVID levels yet, but certainly if I had told you this time last year that the ratio was going to go up 75% in a year's time, I'm not sure most of you would have agreed with me. So again, we look at the final results. So we're always tracking the NASDAQ versus the Dow. So again, another measure of value versus technology, if you will. And so the Dow has done very well, even though, so there's ups and downs on it, but really the past March and late February has been very kind to the Dow. If we're tracking sub-sectors or components of performance, as I've said earlier, this is the top 18. It's a broad selection of names in the U.S. and in Canada, it's much more focused. 50% of the gains of the TSX in the first quarter can be attributed to major financial stocks like the Big Five, Canadian banks, Manulife, Sun Life, and Power Corp. The ETF flow, I like to show that chart every quarter. This quarter, there's not a lot to say. I mean, there's positive cash flows going into the market, record ones, in fact, for the broad index, but we're kind of noticing more money going into emerging markets and obviously the value stocks and the smaller stocks. So it's interesting to watch. There's no clear, there's nothing that jumps out at us. What's also interesting is, on a one-year basis, we had $400 billion go into the ETF market. And so far this year, we've had 200 of that. So in the past 3 months, it represented 50% of all the money added. So there's an acceleration of money coming into the market. That's whereas in Canada, it's not as marked. So it's 30% so far in the past quarter, 30% of the full year's tally. In Canada, again, we're seeing sort of some money leaving the U.S. market. It's kind of a mixed bag where the dollars are going. So it's really not clear. So I'll move on. Here's our usual charts. Again, we're just looking at the shapes here. We're seeing that the shapes are very similar. Canada, the US, and Europe. So these shapes, our thesis is that central banks have inflated assets. And in the emerging markets, the developed market central banks have less an effect. So here's an example of an economy or stock market that the emerging markets where the central banks have not had the same effect. It's also important to note that the emerging market index, China is a large component, and the Chinese market had a rough March. Here we have the VIX, or the volatility index. We're still sub 20, so when the markets are functioning normally and there's no real fear in the markets, we're looking at 15 to 20 as a normal level. This is a spike early in the year, so when markets sell off, you can expect a spike. Our dollar is creeping up. It's had sort of a good run since the depth of March. So your U.S. assets and your foreign holdings are not performing as well in Canadian dollar terms. Gold is still down. It's sort of basing if I showed you a longer term chart. And the commodity index has spiked, this is the oil index. So we're down from the levels, but we're still $60 level, which is a healthy one from a producer perspective. Here are bonds. From the feedback, this is the chart that is the least loved, and so I'll try to do a better job of explaining it. And so really what we're doing here is the white line is the Canadian government bond index, and this is the BBB, or the lowest grade of the investment grade corporate bonds. And so really what we're looking for is the shape. So we talked about a steep curve. See how it was much flatter? Now it's much steeper. So the longer duration or longer dates, the interest rates are substantially higher than the shorter dates. So that's really the first thing that we're looking for. And then we're also then looking for the pivot point. And the pivot point is right around the sort of 4-year mark. And so the low end of the curve went down in terms of interest rates, and right around the 3-year mark is the pivot, not 4-year, but 3 years, the pivot point, and anything past 3 years moved up. And then you want to see the direction. So we see that those rates going up and those rates going down. On the corporate level, it's not as clear in terms of a pivot point. Everything is kind of moved down from previous dates, up from last quarter, but we're still substantially better. So corporations are still benefiting from lower interest rates. In the U.S., very much the same type of point. So there's the pivot point again is around 3 years. The low, anything under or closer in 3 years went lower. Anything above 3 years went higher. And corporations also are benefiting from low interest rates. And so this is kind of an interesting thing where, just 6 months ago or a year ago, investors were worried about the health of credit. And so interest rates or corporations had to pay much higher in terms of interest rates. Now, investors aren't worried about credit defaults at all. And so they're bidding up the value, trying to get an extra interest, a few points in interest. If we move to the stars and dogs, again, this is kind of an interesting name selection. So we're really looking at energy in Canada, a couple of names that got bought out. So that's a good thing. It kind of gives you an idea of 10 names, 20%, or 2 names, or 20% of them were actually subjects to mergers and acquisitions. So that's usually a sign of health in the financial markets. And the cannabis stock and the energy stocks were sort of the larger players. Some of the high flyers are giving back a lot of their names. So Cargojet is one, and also the mining stocks are giving back their gains. In the U.S., we're seeing retailers, oil and steel companies, an airline company. Interesting, I showed you the TSA numbers. So investors have high expectations around travel coming back. A retailer that was really left for dead in the past year has come back. On the losers, in terms of the worst performers, you've got semiconductors, so Qualcomm and Xilinx, and software companies, stay-at-home companies. Take-Two Interactive is a publisher of video games. The numbers are still, they're negative, but there's nothing like what we saw at the end of the first quarter of last year. And finally, we're at the second last chart, and here's a different take on things. So the point here is we stand by our point that expert predictions are really just educated guesses. And so making decisions based on those expert predictions can lead to some surprises. That's why we really adopt a much more broader approach of expecting better than expected outcomes and worse than expected outcomes, and really tilting based on the evidence we have one way or another, but really being open to all sorts of outcomes. So here's a good news story in the sense that these are the projected death a year ago that we had from these two institutions in terms of the deaths from COVID. Now we've had 555,000 deaths, which is terrible. But these are the models that were predicted. So we're substantially below the predictions, which is a good thing. So that's the point. Models can be wrong, and a year ago we were really expecting some dire needs. And unfortunately, we need to look back and see how, as dire as the situation may be, we really need to realize that it's not as bad as we initially thought, what the experts thought. So really having an open mind to lots of different outcomes, we feel is the better way to go. Here's another positive chart. It's our last one. If I had told you a year ago that 4.3% of the population, or 658 million doses of COVID-19 vaccines, would be administered 1 year hence, so from April 2020 to April 2021, that would be viewed as an insanely positive piece of news. Yet, right now, the news media is really focusing on what's not going well in the rollout. I'm not making a judgment part here, but sometimes we have to look back and see how far we've gone and how dire the situation looked just a year ago. Thank you so much for watching. I'll reiterate our goal is remain to own great assets, purchase them at reasonable prices, and limit the risk of the assets that we do own by reducing them or even selling them out when they get vastly overvalued. As always, we thank you for your trust in managing your investments. We look forward to hearing from you, and we also look forward to meeting with you in person when we'll have the ability to do so. Thank you so much for watching.